Your market news now. Asian shares nudged higher and the dollar was a two-month low ahead of crucial U.S. inflation data that will help gauge whether the Federal Reserve is at the end of its aggressive rate hike policy. The JSE was firmer in morning trade. We saw the all-share index up 0.8% to just above 75,000 points higher, and the top 40 up 0.9%. Resources adding 1.5%, and the financials are up just over 1%. Meanwhile, investor attention will also be on second quarter earnings this week, with results due from some of Wall Street's biggest institutions, including JP Morgan, Citigroup, and Wells Fargo. Wall Street banks are expected to report higher profits for the second quarter as rising interest rate payments offset a downturn in deal making. To give us more perspective on the markets, we are joined by Lukman Otunuga from FXTM. Lukman, thank you so much for your time this afternoon. So your sense of market sentiment ahead of that all-important US CPI report later?
Thanks for having me here today, Nastasia. Yeah, there seems to be a sense of optimism across markets, with the dollar weakening, stock markets dodging higher, and even treasury yields falling on expectations around the pending inflation report, dampening the case for more rate hikes. If you look at European markets, they're trading cautiously higher along with US futures. Even commodity markets are smiling, with a weaker dollar pushing oil prices and gold slightly higher.
Are we on course? Is it all set that July is going to be a rate hike? And if so, which camp are you in for what happens in September?
Absolutely. So a lot's at stake here. You know, we already know the figures. Headline inflation is expected to cool to 3.1% compared to the 4% in the last month, while the core inflation, which excludes volatile energy and food prices, is seen cooling to 5% from the 5.3%. I mean, ultimately, signs of easing inflationary pressures, should reinforce the argument around the Fed nearing the end of its hiking cycle beyond July. But if inflation still proves stubborn and persistent, the Fed does already warn markets of 2 more rate hikes, may know what it's saying.
So when that CPI figure does come out, what will you be paying attention to? Is it the core figure that's all important right now?
Absolutely. This is what everybody's talking about. As impressive as the, massive drop in the headline is to 3.1%, it's all about the core, which excludes the volatile food and energy. Still expecting an 88 probability of the Fed moving ahead with a July rate hike. And this is all but priced in September. But that core figure could really change things. If the core figure is still stubborn and persistent, this could, reinforce the argument of an additional rate hike beyond July. But if we see a core figure that continues to slow as quick as the headline, July could be one and done.
If you had to look at risks to equities, what's key for you in the second half?
I've got 4 things on my mind: high inflation, recession fears, high interest rates, and tech stocks. Yeah, there's no doubt that inflation is falling in the largest economy in the world, but we have to keep in mind it peaked around 9.1% last year, and it's still slowing, but not as fast as most expected. Now, persistent signs of inflation still remaining sticky could result in expectations rising over the Fed, keeping rates higher than expected, which ultimately would lead to fears of a recession. When you add the high inflation, recession fears, and high interest rates, this is bad news for tech stocks. Tech is doing well, but it's facing its own trials. If you look at EVs, the stubborn prices in EVs and the competition in AI as well. These are things that could hit Tesla and Alphabet. But yeah, these are the 4 risks I'm looking for in H2 for stocks.
Based on the data that we've seen so far coming out of the US, whose argument is louder right now? Is it the recession argument, or is it the soft landing argument?
It's interesting you say this, because if you look at data in general from the US, it hasn't actually been as bad as expected. Yes, last Friday we had the mixed US jobs report, but the US economy still remains robust. Data in general still continues to meet or exceed expectations. It's just a case of now, if interest rates continue to rise to the extent that it starts to damage economic growth, it could result into that recession fears. Again, The Fed has beyond, a couple of months till September to decide what it does, whether it raises rates once more time or holds rates. But of course, much attention will be on inflation data, the next few jobs reports, and manufacturing data as well.
So you had China earlier in the week signaling an end to the tech crackdown. If you had to look at things, do you think that investors are more confident that there's been a material shift in the way that China is dealing with the tech companies or is viewing them?
I mean, the way I see this, we've seen that Chinese stocks has rallied on this development with a sense of relief that the government has actually signaled an end to tech crackdown. However, though, I think this has reminded investors across the world over the delicate nature of regulatory policies in the Chinese tech sector. I think ultimately it may take some time for investors to their confidence to return. And even though there has been a fine, regulators are still on the watch. So yeah, this is good news, but I think investors in general are more cautious.
All right, Lukman, let's leave it there. Thank you so much for your time. That is Lukman Otanuga from FXTM, giving us his perspective on the latest when it comes to the markets. Of course, we are expecting that CPI data in the next hour or so, and we will unpack the key numbers for you in our market segment.